Tuesday, January 20th, 2026. Silver just tagged a record high. Then it slipped. Not gently, fast. If you felt that whip, you're not imagining it. This market is in risk mode. This is a clean briefing. Only what happened. Only what mattered. No fantasy targets, no motive stories, just mechanics. Quick note, this is educational only, not financial advice. Before we go deeper, if you want sharp, no-fluff, silver briefings when the tape gets dangerous, hit subscribe and turn on notifications, because in sessions like this, hours matter. Here's the lockout score for the last 12 hours. 8.9 out of 10. Volatility, 9 out of 10. Mechanics, 10 out of 10. Access, 7 out of 10. Translation, this isn't silver moving, this is silver stress testing. Here's the clean fact pattern. Silver pushed into fresh record territory. It briefly printed around 95.87. Then it eased back near 94.37. That spread matters, not because it's huge, because it happened inside a hot zone. Record highs do one thing instantly. They change behavior. Late buyers chase, shorts tighten risk, options desks hedge faster, brokers watch collateral, and the chart stops being the story. The plumbing becomes the story. Now 3 receipts, short, clean, verifiable. Receipt 1, silver hit around 95.87 intraday, then eased around 94.37. Receipt 2, a CME clearing notice states precious metals margins moved from fixed dollar amounts to a percentage of notional value. For COMEX 5,000 ounce silver futures, maintenance is listed around 32,500, with the rate shown as 9% for standard profiles. Receipt 3, risk sentiment jumped hard today. Stocks slid and safe haven buying accelerated, with gold also printing record territory. That's the backdrop. That's the tape. Now let's talk about why this session felt rigged, carefully. When a move is this fast, it can feel unfair. But unfair is usually a mechanic you haven't identified yet. In silver, the mechanic that dominates during record highs is simple. Collateral. When price accelerates, notional exposure expands. When notional expands, margin burden rises. When margin burden rises, positions get trimmed. Not because anyone hates you, because risk has a job. So you see the same pattern again and again. Push, air pocket, snap, stabilize. It looks like chaos. It's structure. Here's the key concept. There are price zones where silver trades like a metal, and there are zones where silver trades like leverage. Today, silver was trading like leverage, because in the mid-90s, every tick is amplified through notional math. Let's translate that in 60 seconds. One standard silver futures contract controls 5,000 ounces. At about 95 per ounce, one contract represents about 475,000 in notional exposure. Now pause. Most people never internalize this. You can be right and still be forced out, because the system doesn't ask, are you right? It asks, can you carry it? If your broker tightens maintenance or volatility spikes, you get the message, add funds or reduce. That is how flushes are born. Not because the world stopped needing silver, because collateral got heavier. Now here's what changed with margin and why today gets sharp. Under the old feel, people thought in fixed dollars. Under the new feel, people must think in percentages. A percentage framework means this: as price rises, collateral scales up. So when silver runs, the market quietly becomes more expensive to hold. That has consequences. It reduces the number of players who can stay big. It punishes the most levered. It rewards the best funded. It amplifies intraday swings. And it can create the exact tape you saw today, break out into records, then a fast reset, then a stabilized price that refuses to die. Here's a detail that matters in real life. Maintenance is the line. Initial is the entry threshold. In hot tape, maintenance is the weapon, because maintenance is what triggers margin calls, forced reductions, panic decisions. Today's notice shows maintenance around 32,500 for standard profiles. High-risk profiles are higher, and brokers can be stricter than the exchange. So don't treat margin like a single number. Treat it like a ceiling that drops lower when volatility rises. That hidden pressure is behind today's whips. Now, why the pullback didn't mean failure? This is where most people lose. They see the first red push and conclude, the rally is dead. But in a collateral zone, pullbacks are often mechanical. A pullback can be late longs getting shaken, over-leveraged positions reduced, hedges rebalanced, stops cleared. Then, once the forced selling ends, price can stabilize quickly. So the question isn't, did it dip? The question is, did stress persist? Today, silver eased off the peak, but it did not collapse into a waterfall. That matters, because fragile blow-offs don't ease. They snap, then die. A stronger market can whip, then hold. Again, not prophecy, just tape reading. Now, why record highs create air pockets? This is pure market physics. When price enters record territory, there is no prior ceiling. So traders create new reference points. Round numbers become magnets. 95, then 100. But the market doesn't move in a straight line to round numbers. It probes, it hunts, it tests. And it tests with stops. Stops cluster near obvious lines. So you get fast moves that feel disconnected. They are connected. Crowd placement creates stop clusters. Stop clusters create air pockets. Air pockets create violent candles. That is what today felt like. A market hunting liquidity in record territory. One more macro receipt because it explains the mood. Today's broader market showed classic risk stress. Stocks dropped more than 1%. The volatility index pushed above 20. The dollar index slid close to 98.5. And Treasury yields jumped above 4.3. You don't need to memorize numbers. Just understand the signal. When fear rises in the system, money looks for insulation. Gold gets the first wave, silver gets the louder wave. And because silver is thinner, that wave shows up as fast vertical pushes, then violent repricing. So if someone asks, why did silver feel so crazy? The answer is, because the whole system was running hotter, and silver magnifies heat. That's why this session wasn't just a record, it was a risk moment. The rally is dead, but in a collateral zone, pullbacks are often mechanical. A pullback can be late longs getting shaken, over-leveraged positions reduced, hedges rebalanced, stops cleared. Then, once the forced selling ends, price can stabilize quickly. So the question isn't, did it dip? The question is, did stress persist? Today, silver eased off the peak, but it did not collapse into a waterfall. That matters, because fragile blow-offs don't ease. They snap, then die. A stronger market can whip, then hold. Now, why silver moves louder than gold. Gold is deeper, gold is smoother, silver is thinner, silver is jumpier. So when money rushes into metals, silver can overshoot. Not because it's irrational, because the order book is thinner. So a wave of buying moves price more, then a wave of hedging moves price more, then a wave of risk reduction moves price more. That stacking effect is why your screen looked manic in the last 12 hours. Two engines move the tape. Engine 1, fear buying. When people want protection, they don't bargain, they pay. That creates fast pushes. Engine 2, mechanics. As price runs, risk systems respond. Collateral changes, hedging flips. That creates fast pullbacks. Put those together and you get surge, flush, rebound. Not once, multiple times. That's why your brain felt like it couldn't keep up, because it wasn't a slow market, it was a reflex market. Now options hedging, in plain English. As silver runs through key strikes, options exposure shifts. To stay neutral, some desks buy futures. That buying can push price higher. Higher price shifts exposure again, so hedges adjust again. It can create a feedback loop. Then the moment price stalls, the loop can reverse. Futures selling appears. The tape whips. It looks like a switch flipped because a switch did flip, not a conspiracy switch. A hedging switch. That's why this market can look possessed during record territory. It isn't possessed, it's reflexive. Here's a realistic desk example. Imagine a trader long one contract. He isn't trying to gamble. He thinks he's conservative. Silver runs fast. Volatility jumps. His broker updates requirements. Now he has an ultimatum. Add funds or reduce. He reduces. Not because he hates silver, because he hates a margin call. Multiply that by thousands of accounts. Now you understand why price can dip. Even on a bullish day, that dip is not a verdict. It's a collateral reset. Now let's talk about the word nobody respects enough. Access. Price is one thing. Ability to buy is another. When markets go vertical, access often tightens quietly. Retail platforms add minimums, shipping times stretch, back orders appear, allocation language shows up. That doesn't prove no supply, it proves strain. And strain matters because strain changes behavior. Strain brings crowds. Crowds bring spikes. Spikes bring flushes. So if you're watching silver, don't only watch candles. Watch the small frictions. Those frictions are early signals that the pipeline is under load. Quick explanation of the lockout score. Plain English. Volatility asks, how wide was the range and how fast were the reversals? Today, that's a 9, because silver tagged a record, then eased quickly, inside a large intraday band. Mechanics asks, are rules and collateral more important than headlines? Today that's a 10, because the CME notice confirms margin is now percentage of notional, and silver is sitting in a zone where notional math bites hard. Access asks, are buyers experiencing friction? Not no metal exists. Friction, minimums, delays, throttles. Today, that's a 7, because rallies like this stretch retail pipelines through order volume and speed. Put those together, and you get 8.9. a lockout environment. Now, how to read today's record candle. Most people stare at the top tick. Pros stare at the close. A record tag with a fast pullback creates a long wick. A long wick means buyers pushed, sellers hit, and price discovered stress. It doesn't automatically mean reversal. It means the market found resistance, then tested whether demand remained. In the last 12 hours, the key detail is simple. Silver didn't break down. It eased from the extreme and held in the same neighborhood. That's why I call it a whip, not a collapse, because collapses keep collapsing. A whip is a violent test that stays alive. Now, the don't get farmed rules. Educational only, not advice, just survival rules for hot tape. 1. If the range is dollars, stop treating it like cents. 2. Avoid lazy orders in thin moments. Hot markets can jump. A market order can become a gift to whoever is waiting. 3. Don't place obvious stops right where the crowd places them. Obvious stops get hunted, especially in record territory. 4. If you're using leverage, assume margin can tighten when volatility spikes, because it can. And today's system setup makes that more sensitive. 5. Separate I like silver from I must act right now. Hot markets tempt urgency, but urgency is how the tape taxes you. If you can follow those rules, you stop donating to whipsaws. And you start reading the market like a risk desk reads it. Quick comment check. If you want this format daily, type 1 in the comments. If you don't, type 0. And if you're holding it together in a market like this, comment steady. Now, why CME changed the framework? No overstory here. The notice frames it as a normal review of market volatility to ensure adequate collateral coverage. That language matters. It means the exchange is saying, price swings got bigger, so we need margins to scale with real exposure. A percentage of notional model does that automatically. Fixed dollar models lag when price explodes. So this change isn't mystical. It's administrative. But administrative changes move markets. Because traders don't trade only direction. They trade constraints, and margin is a constraint. One more detail. Standard profiles show 9%. Higher risk profiles show 9.9%. That difference sounds small. It isn't. In a record zone, a fraction of a percent is real money, and real money changes behavior. It forces smaller traders to cut size sooner. It forces leverage traders to de-risk faster. So the same price move creates more action than it used to. That's one reason today's tape felt violent. Now, paper price versus real-world buying. On record days, paper prices can whip while real-world demand doesn't vanish. Industrial users don't rage quit because a candle is red. They plan procurement. They buy on schedules. So when paper pulls back, two things can be true at once. Traders are forced to trim risk while real demand stays present. That is why record sessions often look messy. The market is clearing leverage, not erasing demand. That's also why you should never read one violent candle as the whole story. You read behavior over hours, and in the last 12 hours, the behavior said, record tag, fast reset, still alive. That is a collateral market, not a dead market. Here's lockout in one sentence. Silver didn't lock out buyers by disappearing. It locked out easy entries by moving too fast for sloppy positioning. Now, mechanical flush or real reversal. A mechanical flush often has speed, a sharp air pocket, and then a stall. You see selling hit fast, then you see it lose energy. A real reversal often has follow-through, failed bounces, and time. It doesn't just spike down, it grinds down. In the last 12 hours, what stood out was this. After the record tag, silver eased, but it didn't spend the whole day spiraling lower. It acted like a pressure release. Again, not a prediction, a classification, and classification is edge, because edge starts with calling the tape correctly before you call your emotions. One last thing, if you remember nothing else, remember this. Record silver sessions are not price stories. They are constraint stories. When constraints tighten, tape gets violent. That violence is not proof you're wrong. It's proof the market is crowded, leveraged, and being forced to rebalance. That's the reality of the last 12 hours. Final takeaway. The last 12 hours were not normal. Silver printed a record, then silver whipped. Because collateral mattered. When silver trades in this zone, the chart is the surface. The mechanism is the story. If you want more briefings like this, with receipts, plain English mechanics, and zero fluff, hit subscribe, tap like, and comment steady, because the people who win aren't the people who feel the most. They're the people who stay steady when the tape gets loud. Do you like this personality?